Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be the Thursday, the 16th of May, 2024. So before we start our very interesting Daily Dose of Market Insights for today, let's have a quick look at the disclaimers first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell or any recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term technical outlook, which is very interesting for today, given yesterday's major, I would say that risk event, which is the release of the US CPI data, let's have a quick digestion of what this data has impacted on the various cross-asset classes and as well as other related key risk events and as well as data releases at the start of today's early Asia session. So let us start with the all-important US CPI data first. So the impact of the US CPI data has been more of reinforcement of this ongoing risk-seeking or risk-on behavior that has been taking shape in the market since late last week. And for those who follow our daily dose at the start of this week, which is Monday, I do mention that over here, the markets are more embracing momentum positive factor rather than fundamental factor that is driving this current price action movement from the short to medium term perspective, i.e. later I'll share a chart and that could actually explain what I mean. So basically in a nutshell, market choose to ignore the risk of stagflationary like scenario because i.e. oil prices still remains firm at the key support level. We start to see survey based forward looking economic data like the University of Michigan data that is still pointing to that risk of slowdown in consumer spending because consumer confidence is weak, but inflationary expectation continue to inch upwards. Later I'll flash your that chart again. And with that, market chose to actually build up stock indices where we see a very strong rally across the board. Even the lagging one, which is the Nikkei 225, starts to break out on Wednesday. All right. Next thing over here is that it also caused a positive feedback loop due to positive momentum factor inherent in the stock indices flow over to the FX market, where the FX market also starts to see a slowdown in that US dollar strength. And this slowdown in the US dollar strength yesterday finally has been actually been met in the yen side of the story as well. So for those who actually follow our daily dose, we did mention that the dollar yen on Tuesday itself is at a crucial resistance level. So this is our short-term resistance level. We have more or less been made at 157 level. And because of this, we will actually be less hesitant to maintain that short-term technical bullish bias on the dollar yen. So yesterday, the dollar yen also goes down in line with the rest of the dollar major by showing short-term dollars weakness story narrative coming back into the market. And with this stagflation risk scenario still there, gold prices continue to get bidded upwards, whereas the gold price managed to break currently this Monday, last Friday high. Later I'll flash you the gold chart itself. Okay, so now let us now dissect fundamentally the CPF data releases. All right, so if you look at the CPI data releases yesterday, by breaking down the individual component, okay, over here, let us go to the CPI data first. Okay, CPI data. Yes, the CPI. So market get very excited, right, when they start to read this this particular figure of this interest rate month on month. Okay, so this is the one that is including energy and food. They actually just dipped down by 0.1% to 0.3% from 0.4% on the previous month of March. Okay, and also slightly below the expectation of 0.4%. But if you look at the rest of the other component, the core inflation rate, which is less erratic because it's excluding food and energy, only on par, it came on par with the consensus of 0.3%. Okay, last say market got a bit excited when it dipped down slightly to 0.1% to 0.3% in the month-on-month basis for April. And also the core rate over here, it dipped down much more to 3.6% from 3.8%, but it came in within market expectation. So it's not like at the end of the day, it actually surprised much more on the downside. So the key story over here is that at the end of the day, if you look at yesterday's key inflation metrics, the key metrics are, I haven't dive deeper yet to the subcomponent. It actually more or less came in line with market expectation. Okay, it doesn't actually surprise the market that inflation trend in US gets softer than expected. Okay, but like I said earlier on, the markets choose to rally because of a momentum driven factor instead. Okay, so positive momentum factor driven instead. Okay, so now let's now dive deeper into this inflationary trend. Okay, so within this inflationary trend, there's one particular inflation trend that the Federal Reserve are watching very much more prominently is the services component of it. Okay, so you break down the services component of it. Okay, so this is the one the market got excited. Yeah, it came down the lowest so far this year, but still within the market expectation of 3.6%. It doesn't really surprise much on the downside. So if you look at the services inflation over here, the services component inflation, in fact, actually inches much higher, slightly higher at 5.3% in the month of April. Okay, so actually the services side is not actually slowing down at all, the services component. Okay, then another one, if we were to, within the services, we strip out the food and energy component, we call it the super core inflation rate in the US. You can actually, okay, because you can't get in trading economics, pardon me, you can go it to the Fed, St. Louis Fed data. So this is actually the sticky, it's actually CPI, less food, energy, and shelter. So this is something equivalent to that services component, but I strip off the shelter, the shelter portion of it, means i.e. the housing component of it. All right. So this they name it as super core. Okay. US they have core, super core. So this super core is actually because housing, also shelter tends to be a bit erratic. So some of the Federal Reserve officials, are even I believe that Powell himself, during some of his public speeches, he actually uses this gauge, super core gauge, as a much more a preference, has a higher preference to monitor inflationary trend in the US. This based on his prior public speeches. Okay, you guys can actually Google it up on the internet. So if you look at the super core US inflation, stripping out the missed services, stripping out shelter, you see the rate actually, it came in at 3.13%, just slightly down 3.15% last month, in the month of March. So overall, right, this super core inflation, the level is still rather elevated. Okay, it's still rather elevated on the higher side. It's not actually decelerating downwards. Okay, so like I said, I had earlier is that markets don't always move according to fundamentals. Okay, sometimes momentum factor is driving the driver's seat. You just got to respect it. All right. So later I'll share you how do I know momentum factor is driving to the taking the main seat. 2 days ago in my daily dose, I look at the ratio performance chart of a momentum S&P 500 base ETF versus the normal ETF, and I look at the quality S&P 500 ETF versus the normal ETF. Then from there, could have a gauge on whether momentum is actually leading the market or taking the bets sick instead. Okay, later I'll flash you the chart while I go through the current fundamental situation first, the fundamental play. Okay, and also on during this, yeah, we know that means i.e. in fact inflationary level in US remains much rather elevated, still remains on an elevated level, and domestic demand in US is also not so rosy at this point in time. So if we look at the calendar again, this is the retail sales. Yeah, retail sales. So if you look at the retail sales year on year, it actually came down from 3.8% previously to 3% in the month of April. So it actually slid downwards. So if you look at the trend, this retail sales, that means actual spending, it actually came down. And if you look at the 5-year period, it's rather flattish. But to me, it's more like on a gentle downtrending scenario by showing lower high and lower low. And this data point that I share with you all is actually in line with the survey-based, much more forward-looking survey-based University of Michigan data that I flashed on at the start of this week. Okay, so let's have a quick look again at that particular data set. Okay, give me a minute. Let me load that chart for you guys to see again. Oh gosh, why is it not loading? Okay, good, it's here. Then should be this. Okay, let me load it up. Yes, this is the one. Okay, so consumer confidence is always a leading indicator to foretell us the likelihood of consumer spending, retail sales in the next month, at least next quarter or next 3 months down the road so far. Okay, so you look at it, this one for the month of May, it actually came down to a 6-month low. This was released on last Friday. And forward-looking inflation expectation, this survey base actually tick higher on a 1-year basis and a 5-year forward-looking basis as well. Okay, at 3.5% and 3.1%. And these two data set on the 1-year and 5-year inflationary expectation forward-looking, based on the survey conducted by University of Michigan, foretells us that, hey, inflationary pressure is not actually slowing down in US. Okay, do not forget yesterday's component, the subcomponent that I shared with you, the services component, the super core component, that means services excluding housing, is actually still remains elevated, but market just caught ahead of itself because of the positive momentum that is inherent in the market since late last week. And also yesterday, after the release of this CPI data, official, Federal Reserve official Kashkari, he belongs to one of the camp together with Bostic that is erring towards the less dovish side, saying that if rates are likely to hold on long for a longer period of time. Okay, so he actually saying that rates likely on hold. So he's more on the camp of favoring a no rate cut for this year due to his view on the inflationary trend that is taking place in the US economy. So I believe that he was also looking at that particular set of data that I shared with you all earlier on. Okay, so now back to the story over here. We know that yesterday the S&P 500 or the entire US stock market is very, very bullish. If you look at the heat map, it's actually led by the mega cap 7 stocks again, very strong on the semiconductor sector, which is AI optimism at play. So overall, it led to the S&P 500 and the Nasdaq 100 to fresh all-time high yesterday, but not on the Dow Jones Industrial Average yet, and also not on the Russell 2000. And if I could flash this chart, this one by momentum-driven play by looking at the ratio between the momentum factor ETF. That means this momentum ETF is actually using the S&P 500, but we modify it with those guys, those component stocks that has a high momentum weightage purely based on the price action. Okay, this is how they actually create this ETF. And the quality ETF is based on fundamentals. That means, i.e., fundamental ratio like price to net profit margin, the debt ratio, whatsoever, the typical fundamental ratio. So whatever S&P 500 that has a higher fundamental ratio as compiled by this ETF manager will have a higher ranking inside this ETF. So if you look at the momentum factor, I get the ratio divided by the normal S&P 500. We see them breaking above a very clear major bullish breakout since late March, early April this year. And on last week, it retested this level and staged a bounce off. Whilst the fundamental, more fundamental driven S&P 500 quality ETF, means rank according to their higher fundamental factoring scores, actually still remains lukewarm and lackluster based on their relative performance against the S&P 500, because they still remain capped by this major resistance that is in place since 6th of April 2020. 2020. Okay, so there's no clear breakout yet on the fundamental side, the quality side of the S&P 500 component stocks ETF. This is a factor ETF. So what we could see over here is that the last 3 weeks or 2 weeks of rally has been pretty much driven by momentum play rather than a fundamental play instead. So this is how I narrate the market. Okay, so far so good. Okay, so I believe that my chart is moving well, right? Let me do a check again. Checking my chart also, hopefully it can move. Okay, I think it's moving. Good. Yeah, it's moving. Okay, excellent. Okay, because just now I just froze for a while. Okay, sometimes that's the problem with doing this kind of live webinar. So got to check, make sure that everything is smoothly. Okay, so now another data set I'll highlight to you all is Japan data. So Japan data continues to actually be rather weak. Okay, so this is the GDP data Q1. So Q1 GDP data, it actually came below expectation in terms of the Q on Q. So market is expecting negative 0.4% Q on Q, but it came in at negative 0.5%. The one on an annualized basis, it came much lower at negative 2%, versus market expectation of negative 1.5%. But overall, at this point in time, the yen is not actually weakening because it's actually moving together with the sentiment play of a weaker US dollar scenario that has been taking shape right now due to the current ongoing risk-seeking or risk-on behavior that's being seen in the global equities space. Okay, another one is employment data. So employment data in AU surprise on the upside. 38.5% K jobs added for the month of April, way above expectation of 23.7K that is being priced in for the month of April. So with a rather resilient labor market in AU, that actually also prevent the RBA to actually to have a much more dovish tilt instead. So if we recall the RBA in the last meeting, the press conference by the RBA governor and as well as its monetary policy statement release, they do actually indicate that they remains watchful for elevated inflationary pressure that's coming into the Australia economy, and as well as if the labor market in Australia remains on a firm footing, it will be very challenging for them to actually suggest an interest rate cut in 2024. So given the very rosy AU Australia job data from the employment chain that is much more came in better than expectation, that could actually increase the odds of the RBA of being less dovish for 2024, and perhaps very unlikely there will be a cut in Australia, and who knows, there will be a chance of an interest rate hike as well, because that was actually mentioned during the RBA governors, we call it press conference after the last RBA meeting, if the economic data in AU gets too hot. So that actually also supports the Aussie dollar strength in today's Asia session as well on an intraday basis, very short-term basis. So with that, that is actually the key data and the fundamental, we call it linking the dots, that I like to share with you all for today. So now with that fundamental aspects I've covered, let's now jump straight into the short-term technical aspects right now by looking at the short-term intraday outlook on the various cross asset classes. So let us start with the FX market first. All right, so for the FX market, like I mentioned over here, yesterday we do see this, let me show you the FX market. Yeah, this one across the board, intraday or very short-term dollar dollar weakness, they've being played out across the pair, and even previously the dollar strength was strongest against the dollar yen in blue. We see the dollar yen now playing that particular catch up against the weakness of the dollar that is seen in the other major pair as well. Okay, so that actually in fact the dollar yen having been more or less coming close to the key resistance of 157, which I have been highlighting at the start of this week. Okay, so we know that a very sharp dollars sell off yesterday, as we know that from a technical perspective. Okay, so now don't forget about the fundamental, because now we are doing very short-term technical analysis outlook. We know that price action actually oscillate. All right, so it's like a rubber band. So if a rubber band gets too stretched on the upside or downside in whatever time horizon, be it 15 minutes or 1 hour. So right now we are looking at 1 hour horizon. Why? Because I want to stretch out further to last at least until the end of the US session today. So once the rubber band gets stretched too overstretched too much, it will snap back, pop, snap back. So from a technical analysis perspective, we also could look at this snapback opportunity as well if we start to see a overstretch movement. So we know that this move over here last night is rather overstretched, okay, from a visually inspection perspective. So right now, to make it much more mathematical, I will now throw in some of the usual indicator that I share with you on the respective chart by looking at the RSI. So now let us jump straight into the short-term technical outlook, the intraday outlook on the European in this European stock index, European FX pair first against the dollar. Okay, so let us start with the euro dollar. Okay, so that right, let me hide myself so that you guys could see. Okay, so on the euro dollar, so still recall that yesterday we do have a bullish bias. 1.088 will be the resistance level to watch. It really hit that resistance level, and it's now coming close to the top of this minor ascending channel that I drew from the low of 1st of May. And what's interesting over here is that since it really hit that resistance level and a cluster of Fibo extension level as well, so 1.090 over here is very close to the minor swing high yesterday, or minor swing high, prior minor swing high of 9th of April, which I derived my that yesterday's bullish bias resistance level. And what's interesting over here is that the RSI is in the overbought level, but at the overbought level, it actually shows a bearish divergence. That means showing lower high, whilst price action is doing higher high correspondingly. That means what it means that this is a rubber band overstretch scenario that I mentioned earlier on the hourly time frame. That means there is actually a risk right now on a intraday basis to do a much more pronounced pullback for today, potentially based on the technical elements that I have flashed to you, close to the upper limit of the channel, bearish divergence, and also clustering with Fibo extension level hitting similarly at 1.09, and the graphical resistance minor swing high area of 1.088. So with that, I'll be using 1.09 as my short-term pivotal resistance for today, potentially for a putting away that for a potential minor corrective pullback scenario that may unfold. All right, as long as 1.099 short-term pivotal resistance holds. Near-term support level to watch will be yesterday's US session low for sure, will be at 1.0825. Below it exposes the prior range breakout level or range breakout uh, upper limit at 1.08. Former range down turns into a pullback support, and so corresponding very closely to the 200-day and the 50-day moving average as well. Okay, very similar price action could be seen on the sterling dollar. So the sterling dollar also hit the 1.2685, 2610 pivot resistance level that was highlighted in the 2 days ago bullish bias that we have on the sterling dollar. Now at the top of this ascending channel, and also Fibo extension level at 0.76, confluencing with the minor swing high of 9 of April and 10 of April. So this time around, this RSI here, there's no bearish divergence. Okay, because the bearish divergence must be very obvious. Lower high, lower high sloping downwards, but this one is not sloping downwards. So what you could see over here is that we know that despite not sloping downwards, major FX pair tends to move in hand. At least in terms of the directional basis. So given that it's coming very close to a key short-term resistance level on the sterling dollar and the top of this ascending channel, there could also be a chance of a minor corrective pullback scenario unfolding as well, as long as 1.2710 short-term pivotal resistance holds for today. So next near-term support level to watch will be at 12640 / 12610, which is correspond to yesterday's low, European session low. A break below it exposes the next near-term support at 1.2565, which is this minor congestion area here, and also confluencing very closely to the 200-day moving average. Only hourly close above 1.2710 will invalidate this so-called risk of a minor corrective pullback scenario to see the continuation of the sterling dollar recovery play to expose the next intermediate resistance at the 128 figure level, 12860 level, which is this minor swing higher, 21st of March and the 11th of March and 9th of March, a minor swing high, and also corresponding to the 1.236 Fibo extension level as well. Okay, so that's for the sterling dollar. Now back to the quickly flipping to the Asia Pacific currency, pardon me. So let's start with the Aussie dollar first. So Aussie dollar, still recall that this week we were actually not this week, at the start of this week we do have that bullish bias, but still within that range configuration. So why range configuration? Because if you look at the chart of the daily chart of the Aussie dollar, since the low of 13th of October last year, it has been congestion, we call it oscillating, I would say, oscillating within this symmetrical range configuration. That means the upper boundary is a downward sloping trend line, the lower boundary is an upward sloping trend line. Okay, as you could see over here in gray. So right now the current price action is already coming close to the upward sloping trend line over here, which is at 67.30. So that was our short-term resistance for our bullish buyers for yesterday on the Aussie dollar. So this level has already been met, more or less been hit. And also for those who want to know about the Elliott wave count, is now already see a 5-wave up, 1, 2, 3, 4, 5, and also with a potential 5th wave target very close to the 67.30 graphical resistance as well. Okay, by doing like this, okay, 0.618. All right, 0.618. Okay, and what you could see now is that the daily candle, it hasn't ended yet, but it's forming a bearish doji like spinning top candlestick formation at this point in time. But this is the daily chart. To confirm it, it got to actually wait until the end of the US session. But if you're looking at the short-term perspective over here, there is actually exhaustion has been seen already on the short-term basis. Flipping quickly to the hourly time frame right now over here. So on the hourly time frame over here, what we could see is that the hourly RSI also started to flash this bearish divergence as well by showing lower high, whereas price action was doing higher high yesterday. Okay, so with that, I will be flipping to a bearish bias, at least in the short-term intraday basis, for a potential minor corrective pullback to unfold first in the first step. Will it start to see a big breakdown from here? I would not know, because as a short-term technical analysis bias, I'm now wearing the cap of a short-term lens, or short-term cap, rather than a strategist or long-term analysis cap to do long-term forecasting. So I watch the short-term price action on because this is a outlook for a very short-term intraday basis. Okay, so using 6730/6750, the upper limit of this minor ascending channel that is in place since the low of 19th of April. So that will be my pivotal resistance level, 6730/6750. As long as this level is not surpassed, okay, let me put it, let me write it down. Okay, 6750. So that is something like an excess slightly above 6730, which is the upper limit of this minor ascending channel. As long as this 6750 is not surpassed to the upside, potentially a minor corrective pullback scenario may unfold. First support level to watch for sure is the former we call it range resistance over here that was broken out, now turns into a pullback support zone at 6445 slash 6620. Break below this level re-exposes last Tuesday minor swing low at 6585. All right, only hourly close above 6750 will invalidate this short-term minor corrective pullback scenario to see the continuation of the rebound to expose the next intermediate resistance at 6780 Fibo extension level again, and 6840, which is this minor congestion area over here of 29th of December and 2nd of January. Okay, that's for the Aussie dollar. Then for the dollar yen, it actually broke down below our neutrality zone at 155.90 level, but right now the RSI has already dipped down to the oversold region over here. There is no clear sign of a bullish divergence as well, so potentially there could be a snapback over here. So if you look at the way this the current down move that is moved, it seems to be a 5-wave down move already. 1, 2, 3, 4, 5, with a 5th wave target coming very close at the 15330 level as well. So if you do the Fibo extension to get the 5th wave target, okay, it's one time, and 1.236 are the extension one, which is very close to the 15330 level. So over here, right, given that is 1, 2, 3, 4, 5, there's a potential 5 wave down with a Fibo extension 5th wave target that is coming close to it as well. There could be a chance of a minor pullback for the dollar yen. So how much could it pull back over here? If you do the entire retracement to get that particular resistance, will be that 38% and 50% Fibo retracement, this zone over here. Okay, as well as graphically, the 220-day moving average also acting as a resistance at the 50% Fibo retracement level as well. So that giving us a much more important inflection point where it could actually shape another leg of minor bearish reversal towards the bearish side of the story for the dollar yen. So with that, I will not be put it so tight at this first resistance here. So as long as any bounce didn't surpass above 155.30 short-term pivotal resistance for today on the dollar yen, bearish bias on it. First support level to watch 15330, a break below it exposes 15220/15160. Only an hourly close above 15530 will invalidate this bearish bias to see a very messy kind of choppy price action movement to expose the next resistance level at 155.90, followed by that all important resistance level of 157 figure that cannot surpass to the upside since last Tuesday. All right, since this Tuesday, pardon me, not last week, just Tuesday. Okay, so that's for the dollar yen. So overall here, what we could see is that the FX market, with the exception of the dollar yen, there could be a much more pronounced dollar, we call it minor snapback narrative, given yesterday's steep sell-off in the US dollar. Okay, then now very quickly, let's go to the major indices. So for major indices, let us start with the Hong Kong 33. So Hong Kong 33, yesterday the cash market of Hong Kong is closed, they reopen, so there's a positive follow through. No change, hitting the first resistance level that we highlighted earlier at 19,390. We will still keep the bullish bias intact. All right, so what we could see over here is momentum still remains pretty strong. RSIS is overbought, but there's no bearish divergence yet. So with that, I will have a much more slightly tighter key short-term pivotal support level for today, which is at 18,880. So that's confluencing with Monday's low, and as well as the lower limit of this minor ascending channel that I drew from 1st of May. So above 19,390 exposes 19,980 level, which is the 1.618 Fibo extension level from the low of 22nd of January, and as well as the minor congestion area of 1st of August last year. So only an hourly close below this tighten key short-term pivotal support at 18,880 will kind of negate this bullish tone to kickstart another round of minor corrective pullback to expose the next near-term support level at 18,680, followed by 18,250. Okay, so that's for the Hong Kong 33. Then what we could see over here is no change on the Japan 225, despite the fact that technically it's still bullish. Why? Because price action managed to hit the first resistance and came down, retested this dotted line here. So this dotted line here is in fact the pullback support right now of this minor descending channel, former minor descending trend line that I drew from the all-time high that was printed in late March this year. So no change. I tightened the key short-term pivotal support slightly upwards towards yesterday's low at 38,300. We also confluence with this upwards, going to upwards, slightly turning up 20-day moving average, I think as a support as well, very closely in the next couple of days time. So as long as this tighten key short-term pivotal support holds on the Japan 225, i.e. the Nikkei 225, that is 38,300. The next resistance to watch after 38,930 will be 39,130, followed by 39,500, which is the Fibo, this minor congestion area over here, and the Fibo retracement previously of the previous previous medium-term corrective decline from March all the way down to 19th of April at the golden ratio of the 61.8%. That is 39,500. Okay, so what you see right now is that in fact, among all the major indices that we covered so far in our daily dose of market insight, the one that is lagging behind is the Japan 225 versus the other we call it major stock indices that we covered. So it's more like a catch-up play that is taking shape right now on the Nikkei 225, i.e. Japan 225 index. Then what we have now is the European indices. So European indices using the German DAX as a benchmark continue to actually inch higher to pinch during the Asia session. Now it's actually hitting the first resistance level at 18,910. So I don't want to put it so tight. So in fact, right now, if you look at the first support level, okay, to watch out for will be this level. This is actually yesterday's European session low. Okay, I don't put it so tight at yesterday European session low at 18,820. I will actually put it over here, this curvature point. Okay, this kind of a minor U-shaped point as well at 18,730. So 18,730 will be my Titan key short-term pivotal support for today, 18,730. So as long as any pullback didn't surpass below 18,730, still maintain that short-term bullish bias on the this German 30. Next resistance level to watch will be at 19,030/70, which is the upper limit of this minor ascending channel that I drew. Okay, over here from the low of 19th of April. Above 19,070 exposes 19,230, which is the 1.618 Fibo extension from the low of 19th of April. Only an hourly close below 18,730 will negate this bullish tone to potentially kickstart a minor corrective pullback scenario to expose the next support area at 18,470, which is the minor congestion area over here, 8th of May and 7th of May, that confluence with the lower limit of the minor ascending channel. Okay, below it exposes 18,320, which confluence with the upward sloping 20-day moving average as well, and the former minor swing high of 24th of April. So that's for the German 30. Now, very quickly, the US indices, the US Wall Street 30. So this one hasn't hit the all-time high level yet. So now it's very fastly approaching the all-time high level at 40,020, okay, around 40,020, which is also a Fibo extension level as well one time. So what we could see over here is very clearly there is a clear bullish acceleration, okay, after yesterday's breakout of the ascending channel from 19th of April. So from the start of 1st of May all the way down to yesterday price action, this is what I call a bullish acceleration. Price action came down, tested that previous minor ascending channel upper boundary, and before staging that strong rebound yesterday. So right now, given that the RSI is overbought as well, there is no clear signs of a bearish divergence. That means there's no lower high. However, given this a very strong push up, there could be a chance of a minor pullback over here. So minor pullback could be around hitting this congestion, this range of the candlestick high over here. Yesterday's Marabuzu candlestick high. All right, this is a strong Marabuzu candlestick after the release of that US CPI whatever data, but I don't want to put it so tight at 39,770. So I will use this level instead. It's pretty much clear. Minor range resistance that has been tested one time, two time, three time before breaking up yesterday. So this will be a pullback support, and also the lower limit of this steeper minor ascending channel that I drew from 1st of May. So as long as any pullback didn't surpass below 39,570, we will still maintain that bullish bias on the US Wall Street 30. Above 40,020 exposes the next resistance level at 40,360 / 40,430, which is being defined by the Fibo extension clustering level, and as well as the upper limit of this minor ascending channel as well. Only hourly close below 39,560 will invalidate this bullish bias scenario to kickstart another round of minor corrective pullback to expose the next support level at 39,260, followed by 38,970, which is also confluencing with the 50-day moving average, I think, as a support as well. Now, the US Nasdaq 100, like I mentioned, it really surpassed the current all-time high area at 18,500 level. So this 18,500 level potentially could be a pullback support level to watch out for today as well, given the fact that the price action is been rather steep right now. The RSI is at a rather high overbought level. Okay, so in fact, this overbought level of the RSI surpassed the previous all-time high level. Okay, so the previous all-time high level, the RSI was at 83, and yesterday's RSI high was at 86. Okay, so it's a rather extreme overbought situation right now in the short-term basis for the on the US Nasdaq 100. So there could be a chance of a pullback instead of rather than a bearish reversal. So as long as this pullback over here didn't surpass this point here, okay, I don't put it so tight. So I'll put it at 18,250 for now, because this is a very clear previous minor range resistance breakout now turns into a pullback support level, and also the lower limit of this much more steeper upward sloping minor ascending channel that I drew from the low of 1st of May, also showing us that potential bullish acceleration, okay, from here. Okay, so right now, as long as the pullback didn't surpass below 18,250, we will still maintain that bullish bias on the US Nasdaq 100. Above 18,660 exposes 18,850, followed by 18,990 / 19,055, which is a bunch of people extension cluster. And going forward is also the upper limit of this much more steeper minor ascending channel that I drew from 2nd of May. Only hourly close below 18,250 will invalidate this bullish tone to kind of kickstart another round of much more pronounced minor corrective pullback to kind of retest 17,970, 17,810, which also confluence with the 50-day and the 20-day moving average. I think as a support level as well between these two areas here. Okay, so net overall, we do still see short-term technical, we call it elements are still bullish on the short term for these major stock indices, except the fact that yesterday's intraday up move on the US indices is pretty much extreme, given said that the Nasdaq 100 RSI right now, RSI high that was seen yesterday is rather much more higher than the previous RSI high that was made in the current, the respective all-time high earlier in March, which I flashed earlier. So with that, that could be a chance of a intraday minor pullback unfolding first on these indices, given its very strong extreme rubber band move on the upside on the hourly chart. So with that, let us now very quickly go to spot gold. So for spot gold, yesterday the price action of spot gold is rather gentle. It's not as extreme as the US stock indices or even in the FX pairs. So I do like this kind of short-term, nice, gentle movement. So it's going to actually oscillate nicely within this minor ascending channel that I drew from the low of 3rd of May. So it already surpassed this last Friday minor swing high. Yesterday surpassed it, and now this could be a pullback support level to watch. 23,078, but I don't put it so tight here as my short-term pivotal support level. So I will tighten it, yes, tighter to yesterday's low, yesterday's US session low, which is at 23,054, and also corresponding to the lower limit of this minor ascending channel as well from 3rd of May. So as long as this minor potential pullback didn't surpass below 2,354, we will still maintain that bullish bias on the gold XAU/USD. Next resistance to watch for sure at 2,420, which correspond to the all-time high area of 12th of April, and above 2,420 exposes 2,450 in the first step. Only an hourly close below 2,354 will see a much more pronounced corrective pullback to retest the 20-day moving average, acting as a support, and as well as the former pullback of the upper limit of that bullish descending wedge breakout configuration at 2,337/2,327. All right, next level here. Okay, so still maintaining that short-term bullish bias on spot gold as long as 2,354 tighten short-term pivotal support holds for today. Then yesterday we do see another round of recovery for West Texas oil, very interestingly, despite the push down in that CPI data. So yes, fresh a bullish reversal candlestick. This is a bullish hammer after another retest on the intraday basis on the 78.40 medium-term pivotal support level. So net overall, what we could see over here is that there is actually no clear sign that oil price will start to plunge much lower. So it managed to find a key support level that is being held, and yesterday it started to show a positive price action again, and that RSI continued to shape higher low after hitting that oversold region from 3rd of May. So what we could see over here, it seems to us that momentum is slowly building up in the West Texas oil. But in the short term, do expect some short-term movement. Why? Because it still can't surpass that 200-day moving average that managed to cap previous bullish tone since the 2nd of May, that means the start of this month. Okay, so with that, right, on a short-term basis, we will still have that neutrality bias, neutral between this 77.50 and 80.30, which is that minor range resistance that since the start of this month that the bulls can't surpass. So we will have a neutrality stance 80.30, 77.50, unless we have an hourly close above 80.30, then potentially we could start to see a much more substantial push up to expose the next intermediate resistance 81.70 and 83.60 next. So that's for West Texas oil. Okay, so with that, we pretty much sum up for today's short-term technical outlook across the broad-based asset classes. Now, let us take a look at the key economic data for what to look out for today. Okay, so for today, right, pretty much quiet during the European session. There's nothing. In fact, the US session, yeah, we do have housing data, housing stats for the month of April out at 8:30 p.m. Singapore time later on. Then thereafter, we do have that, yeah, pretty much quiet. Yeah, we have another round of industrial production, 9:15 p.m. And we do have a slew of Federal Reserve officials speaking again, Fed Bar and Fed Hunker at 10 p.m. and 10:30 p.m. Singapore time, then followed by another Federal Reserve official speaking, Fed Minister at 11:30 p.m. Singapore time. So do pretty much interesting to hear their thoughts after the release of yesterday's CPI data. Then during the early Asia session, nothing much. Okay. And yes, tomorrow morning, we do have a slew of important data to take note of from the China side of the story. Housing price data, followed by industrial production and retail sales. Those are up at 9:30 and 10 a.m. Singapore time tomorrow. So with that, that pretty much sum up for today's daily dose of market insight. So just have a heads up, for those who are joining tomorrow's premier in-person masterclass. So I shall see you tomorrow. And tomorrow there will not be a daily dose of market insight. So I repeat, tomorrow there'll be no daily dose. So daily dose will resume again on next Monday. All right. So on next Monday, that will be 20th of May. So with that, do have a great day ahead, and I wish you all a great weekend as well. And we shall speak again soon. Thank you.